Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Thursday morning, October 29th, 2015, and the title of this week's audio blog is An Unprecedented Low in Central Bank Credibility. Actually, part of this audio blog was scripted yesterday afternoon, directly after the Fed's so-called hawkish statement. In texting parlance, ROFLMAO. Look it up. However, since I wanted to follow up with this morning's news as well, regarding third quarter GDP, the cartel's success, or lack of it, in the aftermath of yesterday's post-FOMC precious metal tax, and earnings reports from key mining companies, amongst others, I've written an additional section this morning. Thus, I'll start with what I wrote yesterday afternoon, and let you know when I broke for the evening, before starting again this morning. Okay, it's now yesterday afternoon, i.e. Wednesday, in the day's closing hour of trading. I'm not sure what cosmic force chose me for the role of dissecting the Fed's comical lies and propaganda, but thankfully they've become so accustomed to the PPT, gold cartel, and their own open market operations trading desk having their back, they no longer even try to hide their connivances with wordiness. In other words, the so-called policy statements that more than 100 taxpayer-funded lackeys redline 8 times a year no longer have any more than bare-bones language in them, which frankly, your average 3-card Monte dealer could probably dress up better. Going into the 2 o'clock p.m. Eastern Standard Time statement, money market odds of a Federal Reserve rate hike, which by the way had not been followed until very recently, when quite obviously the powers that be decided to use and abuse it as a perception manipulating tool, were just 4% for an October rate hike, 35% for a December hike, and 44% for a January 2016 hike. In each case, an all-time low. U.S. economic data has been as bad as we've seen since the 2008 crisis, hence last week's Worst Economy of Our Lifetimes article, with this week alone utterly horrifying reports littering the landscape, including durable goods orders, new home sales, Dallas and Richmond regional manufacturing, consumer confidence, mortgage applications, PMI services, the September trade deficit, and API and DOE energy inventories. Global data has been equally bad, and the CRB Commodity Index was again plunging toward the 40-year low achieved 2 months ago. A farcical debt ceiling deal was on the verge of being signed into law, enabling another $1.5 trillion of debt to be added in just 18 months' time. While its current spending, focused principally on defense, was dramatically increased to be paid for by fictional cuts 5+ years hence, and of course, selling oil from the Strategic Petroleum Reserve, of which there's only about $30 billion worth to start with. Meanwhile, the dollar had been considerably strengthening against other fiat toilet papers in recent weeks, against the wishes of everyone from the White House to corporate America. In the case of commodity currencies, i.e. the vast majority of global money, the aforementioned commodity implosion was the principal factor. And against so-called first world currencies like the euro, the dollar's strength was simply due to last week's escalation of the final currency war by Mario Draghi, who hinted that the ECB is strongly considering an expansion of its historic open-ended QE program at its upcoming December meeting. Too bad the yuan is still pegged to the dollar, as last week's surprise PBOC rate cut would surely have strengthened the dollar as well. In other words, nothing but bearish economic data, hyperinflationary monetary policy, increasingly negative sovereign yields, as highlighted by yesterday's article, NERP versus Gold, Who's Left to Join the Insanity Party, and generally speaking, powers that be cluelessness as far as the eye can see, as highlighted by yesterday's article, a 10-ring circus of Keystone Cops. In that context, the inexorable rise of precious metals from the year-long cartel-prolonged basing process was starting to gain steam, with both metals having again broken above the violent lines in the sand set by the cartel at the respective 200-day moving averages of $11.75 per ounce and $15.95 per ounce over the past 2 weeks. In fact, said defense of these widely watched technical levels has been so vicious and blatant that I actually wrote 3 straight articles on the topic last week, culminating with Wednesday's must-read Precious Metals Manipulation Primer. And hopefully, the Miles Franklin blog's relentless coverage of this summer's severe silver shortage, caused entirely by the aforementioned cartel price suppression amidst historically precious metal bullish news flow, prompted you to take action whilst the gold-silver ratio was around its late summer highs. It's still historically elevated today, at 72 compared to 77 a month ago, the 40-year average of 57, and the pre-1970s multi-century average of 15. But at least it's moving back in the right direction, and FYI, I did another gold for silver swap earlier this week, taking my silver holdings as a percentage of my total precious metal holdings to 57% from 45% earlier this year. In fact, even the most jaded apologists of the powers that be, like Steve Leisman of CNBC or John Hilsenrath of the Wall Street Journal, would have a difficult time pretending gold and silver's recent resurgence was insignificant, at least from a technical perspective, even if they've been brainwashed to believe there could never be a fundamental reason to own such barbarous relics. And this morning's pre-FOMC precious metal surge to $11.83 per ounce for gold, which coincidentally is exactly the price it closed 2014 at, and $16.40 per ounce for silver, even had zero hedge writing of how gold and silver are spiking as 2015 rate hike odds plunge. And thus, under the cover of the past 2 months, blatantly PPT orchestrated 2,500 point surge in the Dow Jones propaganda average, the Fed realized its policy statement needed to have a few ambiguous words added so that such mouthpieces like Leisman and Hilsrath can run with it, spinning it as hawkish. No matter that stocks ended up higher than before the policy statement was made, as did oil and treasuries for that matter. In their eyes, all that mattered today was pushing gold and silver, i.e. the Achilles heels of the financial world, back down, which in hindsight was done with the same prototypical attack patterns as always, starting with the ubiquitous Cartel Herald algorithm at exactly 10 o'clock a.m. Eastern Standard Time, i.e. key attack time number 1 when the global physical markets close, followed by further erosion directly after the 12 o'clock p.m. Eastern Standard Time cap of last resort, and of course at precisely the 2 o'clock p.m. Eastern Standard Time release of the FOMC statement, or as I deemed that timestamp several years ago, crybaby attack time. And thus, on a day when the Fed said absolutely nothing incremental, but Wall Street and the MSM characterized it as hawkish, which theoretically is supposed to be negative for stocks, particularly in today's environment of collapsing economic data. The Dow ended nearly 200 points higher, Treasury yields barely higher, and oil prices rocketed 5% higher, and that after the horrible DOE and API inventories. Wilts Gold ended at $11.56 per ounce, down $20 from its pre-FOMC level, and silver $15.98 per ounce compared to $16.35 just before the FOMC statement. And by the way, the dollar utterly rocketed higher to the chagrin of everyone from the White House to Wall Street, corporate America, and the billions of people worldwide that use second and third tier currencies to fund their lifestyles, savings, and net worths. Still, silver closed just above its 200-day moving average, while its gold remains within spitting distance. And given the Fed's own tracking model, which estimates growth of just 0.8%, tomorrow's 3Q GDP report has the potential to be significantly lower than the consensus of a 1.7 to 2.2% increase, which, despite having no statistical significance either way, would likely catalyze an unwind of today's manipulated post-FOMC increase in the so-called odds of a December rate increase, which most likely the Fed's own open market operations desk assisted in rising from 34% to 47%. That said, I can't overemphasize how not only are such odds always overestimated by perma cheerleaders like Wall Street, the mainstream media, and the Fed itself, but the economic impact of such a suicidal action would be catastrophically devastating for global equity, commodity, real estate, and currency markets. Not to mention the Fed's historically over-leveraged balance sheet. Hence, my September 2nd article, the only financial event that could be as cataclysmic as a significant yuan devaluation. And thus, that a rate increase cannot and will not even be considered, as opposed to the polar opposite action of a negative interest rate policy, which in my view is far more likely in the coming months. That said, let's go directly to the scene of the crime to see exactly what was so hawkish about the Fed's statement, at least hawkish enough for precious metal prices to plunge, even as interest rates barely budged and both PPT-supported stocks and oil PPT-supported crude soared, which per today's Audioblog title was so farcical and contrived it easily set a new low in central bank credibility, which is to say simply the latest in a long uninterrupted stream of new lows from the Fed, from the ECB, BOJ, SNB, PBOC, BOE, and all others. To that end, we have witnessed a new set of relentlessly repeated propaganda buzzwords, replacing liftoff, which had pathetically been utilized for most of 2015 to speak of the supposed imminent rate hikes that were expected from the time of Janet Yellen's first prediction of a March 2015 rate hike until the devastating disappointment when no rate actions were taken in September 2015, which are open the door and live meeting. That is, that no matter how dovish the Fed's actions and words are now, so long as they leave the door open for a possible December rate hike, making today's meeting a live one, this is somehow bearish for precious metals. Not stocks, mind you, despite the entirety of this summer's equity decline being blamed on rate hike fears. But precious metals, which despite record demand, plunging inventories, and the weakest production outlook in decades, are expected to fall if the Fed is too hawkish, too dovish, or anything in between. That said, what they actually said in leaving interest rates at zero for the 83rd straight month was as inconsequential as it was purposefully vague. And despite their blatantly propagandist goal of spinning it as hawkish, which would make zero practical sense given how violently negative global economic data has been since last month's meeting, not a word was uttered of a potential rate increase, and nothing but a handful of ambiguous words changed. In fact, the only positive development since last month's meeting has been the PPT goosed increase of global stock markets, which should tell you all you need to know about what the Fed really cares about, and conversely, what they could truly care less about, i.e., the plight of the 99% and the Main Street economy that employs them. Which is not news, of course, to anyone with both a pulse and an open mind. To wit, here are the only changes to their monthly word cloud, which in sum total, as usual, say absolutely nothing incremental. To start, they changed September's household spending and business fixed investment have been increasing moderately to household spending and business fixed investment have been increasing at solid rates in recent months, which, whilst theoretically hawkish, makes absolutely no sense given that since the initial statement was made a measly 5 weeks ago, September retail sales, durable goods orders, and industrial production were all reported to be negative, as were the PMI manufacturing indices in China and essentially all other measures of global capital investment and manufacturing growth. Next, in complete contradiction to the above, supposedly hawkish view, they changed September's "the labor market continues to improve with solid job gains" to "the pace of job gains slowed." Not to mention, LOL, September's "market-based measures of inflation compensation," whatever inflation compensation means, moved lower to "market-based measures of inflation compensation moved slightly lower." Whoa, stop the presses. A metric that no one has the slightest clue what they're even referring to changed from moving lower in July and August to slightly lower in September. Next, a wording change that describes exactly what I mean by the Fed caring only about stock market movements, particularly in light of the fact that they and their global central banking compatriots support stock markets as aggressively as they monetize bonds, often overtly so, which is in omitting the controversial "recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term," just 1 month after initially putting it in. And this following a month of plunging commodity prices and economic activity and exploding geopolitical unrest in regions as diverse as Brazil, the Middle East, and Catalonia, Spain. And last but not least, in what can only be characterized as their latest attempts to keep markets in a constant state of confusion, they changed "in determining how long to maintain the 0 to 0.25% Fed funds target range" to "in determining whether it will be appropriate to raise the target range at its next meeting." This comically inconsequential, blatantly misleading change was, of course, interpreted within picoseconds as violently precious metal bearish, and of course, bullish for all desirable asset classes like stocks, treasury bonds, oil, and the dollar. Even though not only did it not mean anything, but it was quite obviously put in solely to keep markets off balance. And of course, the fact that all of the Fed's previous attempts to telegraph potential rate hikes, falsely or otherwise, have been decidedly wrong-footed, from the ballyhooed replacement of considerable time in December 2014 with patient, which supposedly meant the Fed was getting ready for the aforementioned March 2015 rate hike that never happened, to, in March 2015, similar to what they did today, removing patient in lieu of "the committee judges that an increase in the target range for the federal funds rate remains unlikely at the April FOMC meeting." In other words, suggesting a rate hike was possible shortly thereafter, which again in hindsight never happened. And equally comically, when April came, they took out all reference to specific meetings in lieu of simply ignoring timelines entirely, which is why today's reference, not to the probability of a December rate hike, but simply that the topic will be discussed at that point, is so comically moronic. let alone amidst an environment of collapsing economic data, commodity prices, and heck, confidence that Keystone Cobb central banks have a clue what they're doing, other than purposefully destroying currencies and propping up insolvent banks and overvalued financial markets. And oh yeah, don't forget that despite such dramatically important word cloud changes, which I say as facetiously as possible, they didn't change a word of their standard boilerplate about all future decisions being 100% data dependent. Not to mention, even more laughably, that they still expect inflation to rise gradually towards, my note, the mythical, manipulated, statistically meaningless level of 2% over the medium term as the labor market improves further and the transitory effects of declines in energy and import prices decline. As for transitory, it's now been 11 months since Whirlybird Janet first deemed the oil price plunge transitory. And by the way, when she first said it in December 2014, deeming it LOL, a net positive for the economy, WTI crude was $60 per barrel compared to $45 per barrel today. As for plunging oil prices being a net positive for the economy and the labor market improving, what part of collapsing retail sales, manufacturing activity, labor participation, and real wages supports such a blatantly erroneous, or at best fallacious, statement? In other words, endless lies and propaganda from the world's leading central bank, which sadly is leading nothing except the global collapse of economic activity, commodities, currencies, and political and social stability. Well, that's enough for now, as I've already scripted more than 4 pages today, atop my article this morning and a Crush the Street podcast. I'll be back bright and early tomorrow morning, so until then, sweet dreams. And by the way, catch my new SGT Report podcast, which just came out as I am writing. Okay, I'm back. It's early Thursday morning, and the much ballyhooed agglomeration of meaningless rigged data that is the third quarter GDP report is not yet out. Overnight, the biggest news was Deutsche Bank, Europe's largest bank, reporting an even worse quarter than its September pre-announcement portended, of 6 billion euros. In the process, announcing plans to eliminate its dividend entirely and raising its estimate of planned layoffs from 23,000 to 35,000 as it exits 10 countries. To that end, if FDIC Vice Chairman Thomas Honig deemed Europe's largest derivatives purveyor so horribly undercapitalized it's ridiculous 2 years ago, what does that say of where they stand today, now that the global economy has collapsed, and with them, loan demand and credit quality? Or for that matter, the thousands of banks not as large as Deutsche Bank, both in Europe and elsewhere, and not considered too big to fail. On the earnings front, it appears the major miners will be able to avoid major write-offs this quarter, based on the reports of Barrick and Newmont, the world's 2 largest gold miners. Of course, mid-year write-downs are rare events, and given that gold and silver prices, whilst a few percent lower on September 30th and June 30th, have since recouped most of those losses, it would seem a more prudent decision to simply wait for year-end to reevaluate reserves and resources, as they're mandated to do. Which, I might add, can be written down for a variety of reasons other than falling prices, as the world's 5th largest gold miner, Kinross, demonstrated in spades last year. That said, Barrick's $264 million third quarter loss, comically reported as a $131 million profit after the one-time adjustments that occur each quarter are backed out, demonstrates exactly how profitable even the world's largest gold miners with the lowest cost mines are at today's historically suppressed prices. An ugly experience duplicated, I might add, by the world's 4th largest gold miner, Goldcorp, which is famous for having some of the world's lowest cost gold mines, which, just as I finished scripting, reported a third quarter loss of $191 million, and even when excluding said non-recurring items, it still lost $33 million. And by the way, Barrick, the world's largest gold miner, added to its ignominious quarter by reducing its 2015 production guidance from 6.2 million ounces, from 6.2 to 6.6 million ounces to 6.1 to 6.3 million ounces. Again, demonstrating exactly why I'm 1,000% convinced that peak gold and silver for years to come arrived this year. Well, it's now just past 8:30 a.m. Eastern Standard Time, and as I suspected, the 3Q GDP report was a major disappointment, coming in at a measly 1.5% growth versus expectations of between 1.7 and 2.0%, i.e. the second lowest print of the past 2 years, with only the now double seasonally adjusted print from this year's first quarter, which prior to said adjustments was reported to be negative, coming in lower. In other words, yet another number well below anything even remotely considered growth, even by the standards of today's historically manipulated data. And by the way, pray tell how personal consumption expenditures could have risen 3.2% from a year ago when overall retail sales have been flat at best. Heck, said data has become so egregiously false, today's weekly jobless claims 4-week average plunged to its lowest level since 1973. And this with U.S. labor participation rate at its lowest level since 1977, real wages at those same mid-70s levels, and oh yeah, corporate America set to have its most annual layoffs since the aftermath of the nation's worst financial crisis since the Depression in 2009. Given the hideous GDP report, which in light of the precipitous drop in economic activity and commodities in September will likely be revised lower, why anyone would think the Fed would even consider a December rate hike is beyond me, let alone as such an event, which as noted earlier would likely be a cataclysmic death blow for risk assets like stocks, would occur just a week before Christmas and less than 2 weeks before year end, when the Fed's Wall Street masters rely on PPT-goosed Santa Claus rallies to pad their exploitative, ill-begotten bonuses. In other words, proving my point that yesterday's bogus FOMC hawkish propaganda was a 100% fabrication. Yet again, proving the point that nothing the U.S. government, the Federal Reserve, Wall Street, or any of their partner in crime reports can be trusted. As for markets, when I awoke, Dow futures were down 70 points. And as I write 3 hours later, just before the New York Stock Exchange opened, they're still down 70 points. Treasury yields and oil prices are roughly flat, and base metals are down sharply, as they too were when I awoke. So it looks like the only markets to have materially moved in the past 3 hours, during which the aforementioned wildly precious metal bullish news items emerged, are paper, gold, and silver. After their customary 2:15 a.m. Eastern Standard Time plunges, gold was still up $4 or so to $11.60 per ounce when I woke, and silver roughly unchanged at $15.95 per ounce, i.e. right at its 200-day moving average. And yet, just as the COMEX opened and the hideous GDP report was published, prices waterfalled lower to $11.53 per ounce and $15.75 per ounce respectively, again as no other market materially budged. In other words, yet again demonstrating just how terrified the cartel is of gold and silver breaking above the 200-day moving averages, which inevitably they of course will, as the aforementioned factors will only serve to increase demand further, deplete inventories, scarce inventories I should say, and yield dramatically lower production. To that end, we can only reiterate as vehemently as possible that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. Consequently, if you are considering the purchase, sale, or storage of precious metals, we simply ask you to give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks and have a great weekend.